But otherwise, like we got the same idea with the collar and the green.
Yeah, I don't know how he did that.
Well,
You're buttoned. I'm unbuttoned.
you know, this has
Actually, in
been a real.
fact, got no buttons.
Oh, okay. That's so lame. I mean, that's okay. These shirts look stupid if you unbutton the top one. You know how some of those collared shirts just look really awful unbuttoned at the top.
That's the
They're just
bane of
kind
my
of
existence.
wonky and all over the place.
Mm-hmm.
But if you button them up, it looks like you were shoved into lockers in high school. I agree with that too. So actually, I found the solution's a tie. You wear this shirt with a tie, and it's great.
Yeah, that brings it all together. But
It really
that's the
does.
other really sad thing now. People don't wear ties anymore.
Yeah, you'll get you'll get chirped quite a bit at work.
Yeah, you have to be like the CEO or a politician. Yeah, no one. Yeah, exactly. Like, what's this guy doing?
Oh, what's with the tie? And be like,
Mr.
look,
Mr. Tryhard over here.
Exactly, it looks stupid both ways.
It's the root of all evil, of strife.
Yeah, I mean, I think this to me is sort of my summary of the Ray Dalio book that just came out, How Countries Go Broke, the big debt cycle. So this came out like 3 weeks ago now. I've gone through it, and I thought it was a little strange how he organized the book, because like the section that you're going through where he dictates that there are 9 stages, and he sort of organizes them in 3 chapters. So like the first chapter is like stages 1 through 4. But then when he wants to talk about the US, he structures it not like in these 9 steps. He structures it by the monetary policy that they're in. Mm-hmm. And even then I was like kind of looking at it and it didn't totally line up. So like it's those 2 structures here that are on this slide. Kind of the top is how he segmented and divided the sort of American section when he wants to look at the US American debt cycle. And then these at the bottom are just more broadly what the like long-term debt cycle looks like and what stages. And I've kind of done my best to line them up just kind of from the 1945 period. But even then, he starts at 1945 and he says that that's because that's when the New World Order started. But even then, it's like, I'm not super interested in when the New World Order started. I'm interested in when the long-term debt cycle started. And then he's like, okay, well, that's monetary policy 0. And monetary policy 0, by the way, what he talks about is defined by having the currency directly tied to the gold standard. But,
hard currency, physical asset.
Hard currency. Thank you, Joe. But that didn't start in 1945. That was there that was there before. And
like always pretty much, right?
Yeah, I think so. And in fact, he even put a couple paragraphs in there talking about how in like 1933 or whatever, Theodore Roosevelt had devalued the currency. Well, okay. We're getting a little ahead of ourselves. Let me just walk you through this. Let me just walk you through it like the broadest possible terms.
I know you're excited, Luke.
God,
let's do it.
So I'm ready. I've been waiting to talk about this for months. But so the first part, he divides the U.S. story into the monetary policies sections, and the MP0, monetary policy 0, it's a hard currency. It's tied to the gold. And then it stopped in 1971. So that was the end of it being tied to gold. And that's sort of illustrated in this chart, which we're going to zoom in on really quick. Next one is the monetary policy 1. So that's defined by being able to stimulate the economy with interest rates only. That ended in 2008. And this chart is going to show you what that looked like. Then he says monetary policy 2 is really defined by when the central bank wants to stimulate the economy, they can't just do it to interest rates. That one dropped to 0, and they have to start buying a whole bunch of bonds. They have to actively get into the market and conduct quantitative easing. That's monetary policy 2. And then he does this thing where he kind of hints at the fact that monetary policy 3 had started after COVID, when it's not only that the central bank can stimulate the economy, but you also need the government, you need the fiscal side to start pumping money into, I think the way he phrases it is getting money into the hands of the right people, right? So you got to put it in the hands of individuals. You can't just buy a bunch of bonds from investors. Mm-hmm. So that's kind of the fiscal side. He sort of plays with that. I don't think, in my reading of it, and that's sort of what this question mark is, I don't think he fully commits himself to saying that. He says, like, this is kind of what it would look like. And I think one of the reasons he might not fully commit to it is because there was also a big stimulus package in 2008, right? A fiscal stimulus package. So you're kind of flirting with that idea, but that was my read. Now, this bottom half is his explanation of the stages of the long-term debt cycle for all countries. Right? This is just generally what he's seen, and he is very much he is a student of history, and he's a macro investor. So it's not as though he's only investing in the United States. And throughout the book, and it's very interesting, he'll pull examples from a bunch of other countries and different historical events. So he likes Argentina, seems to come up kind of a lot as an example. Turkey today is an interesting story. So he's pulling from a lot of countries over time, kind of showing what happens. And let's just run through just really quick the 9 steps. And these are not taken verbatim, but they're written very concisely at kind of the beginning of his chapters. So the first stage, and I've sort of overlaid this on our timeline for the US. Again, I'm trying to mash these two things together. The first one is the government and the private sector get deep in debt. And I've sort of displayed that here. I think that's kind of interesting. You wouldn't expect the long-term debt cycle just to be the first step out of 9. Just be like, you're big in debt. Maybe you would have liked to understand how that happened or whatever, but he's just like, no. Stage 1, you get deep in debt. And they say,
yeah, I mean, like, isn't it like, it's not like that's something that happens all of a sudden. It's like a slow burn for like decades over time. It's like, I think we briefly started to touch on it last time. It's like governments kind of always extend more credit than, is available on the, like monetary base. It's in politicians, it's in their interest to extend more benefits, more credit, what have you, as much as they can, pretty much. And so over time, that just accumulates, and then that's the start of step 1. Once too much accumulates, is kind of like how I was thinking about it.
Yeah, it's not just the government, though, because there's a very interesting insight into the private sector as well. But you're right, though, the fact that slow burn, stage 1 here takes like 60 years. It's not like some instant thing. After that, the step starts happening like really quickly. So these stages are by no means, based on time. They're just based on like event. So you're coming into long-term debt cycle, and just like they get deep in debt. And the reason is just credit and debit credit just feels really good. So then stage 2, there is a private sector debt crisis and a government bailout. So I'm going to say, okay, let's call that 2008. Debt crisis and bailout. Then 3 and 4, they start talking about government debt squeeze and a selling of government debt, tight credit, weak economy. So far, this is also, I guess, 2008. But then they start talking about declining reserves and downward pressure on the currency. And this is sort of, I think, maybe like step 3 and 4. And he spends a lot of time talking about the currency exchange rates. He talks about reserves a lot at central banks. He talks about defending currencies. None of that is particularly applicable to the US. And I think this might have been like one of the problems he had, I'm guessing, he being Ray Dalio, when he was organizing and structuring the book, because I don't think it fits super neatly. I was kind of curious to get your thoughts. But like I was trying to map this on here. I'm like, where is that? Maybe we haven't even gotten to stage 2 yet. You know what I mean?
Yeah. And like, I think that's the, obviously like the fundamental issue here. None of these things formulaically follow this. They roughly, like most of them, follow this in some form or another. And like in those earlier chapters that I'm going through right now, like he begins them by saying, like, I'm pretty sure it's like, none of these include modern day US, Europe, China, or Japan. I don't think he says explicitly why, but this might be one of those reasons. Like we're still trying to kind of map it out at this point. Like we don't know if we're finishing up 3 on the edge of 4, or like, are we still kind of in the 2 area?
Or maybe in 6A. I think we're probably in like 6A. The reason why I think that is because step 5 to me very clearly lines up with the move from monetary policy 1 to 2. So he describes rates hit 0%. That was 2008, 2009. Central bank buys bonds and keeps rates down to ease credit. That's quantitative easing. Government shortened maturities on debt. That's also true as well. So like stage 5 to me just lines up perfectly with monetary policy 2.
Yeah, I mean, just literally speaking, when I was looking at 4 right there, I could almost say you saw signs of that in Liberation Day even. And I think that's what Larry Summers was talking about when he kept talking about Juan Perón and that sort of, there was downward pressure on the US dollar. At the same time, there was mass selling of government debt. Now that trend didn't continue, but I think that is like one of those telltale signs whenever something like that does occur, especially for a country like the US where that's very unusual.
Yes, I think he also, but he does spend a lot of time kind of articulating how there are plenty of the smaller cycles that happen within the long-term debt cycle. I think he even starts by saying that since the beginning of this long-term debt cycle, and honestly, I think he says that the beginning was like 1860 or 65 was like the end of the Civil War. I think that's when he decides to start it. Right. Although I would have really appreciated a little bit more, a couple more words describing how the previous debt cycle ended. It like he went ahead and said, okay, around this time, the greenbacks came around, which were not a promise and not linked to gold, for example. And so are we as the reader supposed to be like, okay, so does that signal the end of the debt cycle? Or like, is it just, he kind of also says that, oh, wars typically are the end of the debt cycle. And it's like, okay, so is that the reason why? I kind of wish there was a little bit more verbiage around, or more convincing of me that what the previous long-term debt cycle looked like when it ended.
Yeah, I definitely felt the same thing. And especially in the context of his previous book that he published.
New World Order one?
Yeah, that one. In that one, he talks about the 3 major global reserve currency regimes starting from like the 16th century until today. And he kind of outlines it like 1945 was the end of the previous one. And
so he did. So in the World Order ones, it's very clear. And he starts, and he says we're going to start in 1945 because we're going to start the detailed explanation in 1945 because that's the New World Order. That's when it began. I don't think anyone's going to argue with that, but I'm not interested in the New World Order. I'm interested in the debt cycle.
The big cycle.
The long-term, the big debt cycle. Yeah, how countries go broke, what the long-term cycle is. That's what I'm interested in. And I don't think it really started there. And I think he didn't start there because it's not super clear when it starts.
I guess like the whole point of this, right? Because it's not super obvious how you define these things. It's like you try to look for patterns, and it's doing its best here. But
yeah, you're kind of seeing when you really dig into it and put it on a map like this, it starts to become a little clearer. I think clearer as to where trying to fit a square peg round hole thing. But anyway,
but like even then, like continuously, you can like continue to make arguments for, actually, I think we're in this stage at this point in time, or this cycle started back then instead of now. Are we in M3 or M2 still right today?
Yeah. And we're going to like dive into each one of these graphs real quick. And I wanted to make a point, but it feels like we are trying to get back to MP1. Let's talk about when we get into it. But like we keep talking about lowering the size of the Federal Reserve balance sheet. Ultimately, it's an attempt to try to get back to MP1. But anyway, the last thing I want to try to convince you that we're in 6A though. And so we talked about 5. 6A is when rates rise, the central bank cash flow is negative. So that's what's happening right here. These are the monthly remittances, and they've gone negative after they're being positive for the longest time. He says in there that's a red flag, but it's not that bad. It becomes really bad when 6B hits and the central bank starts printing money to cover the cash shortfall. So right now
the bond vigilantes come in.
Even potentially a lot long after that, after the government can't really cover the shortfall for whatever, it needs, the government itself needs the money, because right now the US government is sort of covering it. After that, I think pain happens in 7. The debts are restructured and devalued. That's a hurt. And he talks about 8, extraordinary taxes and capital controls are commonly imposed. Debt is reduced and there's a return to equilibrium. So I think 7 is where the pain happens. I would say we're at 6A right now. And I think he also says that 6B, he doesn't feel like it's an immediate concern. And I sort of have that same sense. There's still some room here. But that's where the red, I guess that's where, according to his framework, that's where the biggest red flag would be. Anyway, let's go through this slide by slide. But the first one I want to talk about, we'll go through the top 3 pretty quickly. I think these are the juicy ones. He talks about chapter 11, 1945, 1971. So what I mean, how he was dividing this, the description of the U.S. We went from a hard monetary system to a fiat or a soft one. And that very clearly shown in this chart, which is, this is just the price of gold, not adjusted for inflation. So it was marked right here. This is $35 for the ounce. But you can see here, he wants to start at 1945, but it was already, because this is monetary policy 0, but it was before also pegged. It was also a hard currency. And he did talk about, there are words in there talking about Theodore Roosevelt having devalued it. And he sort of presented this as another example of how, just the natural tendency for money to be devalued over time. And he pulled this example right here. But regardless, this was his first point. Let's look at this one. So this is the look from monetary policy 1 to MP2. This is right here, the red line. This is where the short-term rates hit 0. And then the central bank holdings start, going up because that's the only way they can further stimulate the economy, because interest rates by itself is not doing that. You'll see also kind of interesting that there's sort of like 2 of them. You'll see, the Fed dropped it to 0, need to stimulate a little more. But then they started to try to go back, and they're open about this, trying to go back to an interest rate driven monetary policy. But then sure enough, COVID hit, they're going to some hard time, and then bam, they're right back into the QE mode, and it just took another step up. It wouldn't be too hard to imagine that, they're going to try, they already are trying to reduce the balance sheet, and they've been able to do it for a few years now. But all it takes is just something bad to happen that would knock back another step up potentially.
Like, something else important is that if you look at 2018, so that's when they began their efforts to lower the balance sheet again. But if you squint back to 2019, pre-COVID, that bar is already higher again. COVID was not even on the scene yet. So that's effectively as far as they could go.
What?
And as of today, and then same thing, as of today, they're nearing the end of balance sheet roll off. So it's going to be a little bit lower than that. We're still just structurally higher than we were in the mid 2010s. And then obviously same thing as compared to the 2000s before that.
Yeah. Do you remember why? Why did they start to lower rates in 2019?
Lowering rates was, so a big event was December 2018. Conditions in financial markets were basically just starting to tighten a little bit. People were kind of thought, all right, we're at the end of this rate hiking cycle. We don't think the economy can take much more of it. So let's, stay put for a little bit. Let's see what happens. And then just ahead of Christmas in 2018, there was a large financial market shock that wasn't really due to anything super obvious happening. It was just seen as financial conditions were getting too tight again. So people said, Powell was kind of forced into lowering rates at that time. I think the more interesting one, though, is in 2019, whenever quantitative tightening ended very abruptly. So this was a really fun one because this is when I was at the Fed on the Fed trading floor that day. And what happened was the repo market actually blew up. The repo market totally broke, more or less, people were saying. And so the Fed was forced to stop reducing the size of their balance sheet. The size of the balance sheet is so important because it dictates how much free cash is available in the system for banks to do their business every day, basically financial intermediation between, the entire system. They were lowering it gradually throughout 2018, and they knew they couldn't take it down the whole way back to, the 2007 level, because the fundamental way in which they were controlling the front end interest rates was completely different. So going into the 2008 crisis dictated that, so they needed something new. Like a relic of that was that, all right, we need far more reserves in the system, like a couple trillion more. So that's why they couldn't go all the way back down, but they didn't know how far that they could go. So they were doing their best to, let's go slow and steady and just kind of, let's see how far we could go. And then, the Fed actually did a lot of studies on this that I actually worked on a little bit. We're trying to figure out, what is that number? How far can they reduce the balance sheet? And we did this survey every 6 months where we basically just, the Fed went out and just asked the banks, how much do you need? All right, you need this much, but how much do you really need? We're trying to answer, because, naturally, if the Fed asks you something, you're going to do better than what you tell them. So that's a tricky question, but, we did all these surveys, we're doing this analysis, we're trying to figure that out. And we came up with some number that we thought was pretty good. And we've nearly doubled it just to try to be really conservative. And we were feeling really good about it. And then we were just way off. And then I think it was and then one day in September of 2019, it kind of came to a head. We hit that point where there's just not enough cash in the system anymore for banks to intermediate the flow of capital everywhere. And so the Fed had to go in and start buying bonds again, basically expand the balance sheet, inject cash into the economy, even though at that time the Fed was saying this is not QE, but they had also recently started lowering interest rates again the year before, like I just said. So there was a lot of strange kind of footwork near communications work of what the Fed was trying to do, but it was really kind of a complicated situation, to be honest.
Interesting. Yeah, I wish we can go into a little bit more depth. We don't have time in this episode, but that's I have a lot of follow-up questions. I didn't really fully appreciate that. During that time, I was also at the Fed, but I was on the supervision side. You sound like you're much closer to what was going on here. You also mentioned another point that we need to explain. This is central bank holdings. So it's on the one half, on the asset side, they're holding U.S. treasuries. But what you're kind of alluding to, it's also how much cash there is in the system, because on the liability side, it's reserves. It's basically what other banks are holding their cash at the Fed. Two sides of the same coin here. So yeah, they're buying a bunch of securities, and in return, they're giving people reserves, and that's where the printing happens. In Dalio's book, he phrases it kind of interestingly. He says, they're not really printing money. They're just borrowing money from banks to purchase it. And that wasn't my understanding. I mean, the money, the way in which they go from this to this is not, correct me if I'm wrong, but the place where they get the cash is they just make it, right? That's how they get liquidity into the system. So anyway, that's MP1, MP2. The last one I wanted to mention was MP2 to MP3. And here he gets a little, questionable. Before it was, we were looking at central bank holdings, and that's what the graph looked like. This one I decided to put it against, the Fed funds rate is still here on the right side, but then we have the US government expenditures. And, you can see it ticks up. We complain about this and whine about this all the time. And you can see it spiking up. He was sort of making the point that MP3 is when there's a little bit of a breakdown between the central bank and the federal government, and they're both kind of trying to stimulate the economy. And the way the fiscal government does that is by pouring money into the economy, which we talked about. So here's a graph that kind of just describes that. Maybe he didn't sound in reading it to be as convinced, frankly, that we were in MP3 now. In my view, I don't know. I don't think you've gotten quite there yet, Joe.
Yeah, but yeah, I mean, at the same time, though, like you said earlier, there was also fiscal stimulus over the 2008 era. If it's defined just as fiscal and monetary policy coordinating in the same direction, which is needed to stimulate activity, then yeah, you could definitely make an argument it happened in 2008 already. But it seems to be a lot more accentuated in after 2020. It's like back to that government expenditures chart, just the magnitude of which it increased into 2020, 2021 versus like 2009 is much larger.
So we can leave that with the audience kind of to decide, but that's our take. Okay. Now, all right, the good stuff. Let's talk about the 9 stages of the long-term debt cycle. And this is the archetypal one, and this is me trying to slam it onto the timeline of the U.S. So the first one, the government and the private sector get deep in debt, and then there's a private sector debt crisis and a government bailout. So that's stage 1. I'm saying it's from 1945. I'm going to say stage 1 and 2 are around like 2008, 2009 territory. And what he argues, this is the private debt. I'm going with securities only. Just that's kind of has to do with the data that I had available that I could make the actual chart. Although I think the Federal Reserve, who has another chart like this, so I'm going to show here, has a kind of a similar conclusion, similar shape, which I'll show you. So this is the private debt here. And then you'll notice in 2008, and then the government debt or the public debt is going to be this sort of light gray line, that gray part of the bars, and then total debt is the total. And then over here, it is the government debt divided by the private debt. So one of the charts that he has in here, in order to illustrate his point as to what's happening in stage 2, when there is a government bailout, is he just takes the total amount of government debt, divides it by the private debt. And he'll show that number increases, meaning that what he's trying to say is that the government debt, or the government, is taking on the bad debts of the private sector. That number goes up. And, to be fair, that's what it looks like. So, this red line is basically just the public debt divided by the private debt. And, even the numbers are pretty similar. We're going kind of from like this 80 kind of section, a little bit higher than that, and then we're blowing up, but the shape is quite similar. And it happens around 2008. So obviously we know about that crisis. The government took on a lot of the bad debts. So I'm going to go ahead and say that's stage 1 and 2. What do you think, Joe?
Definitely seems reasonable to me. So do you think like 2008 is the start of stage 2?
Yes. Yep. The other thing, and this is kind of go a little bit ahead of the curve. One of the big kind of high level thoughts or higher level observations I feel like that I had to do with how the debt sort of just moves through the whole economy. So it says it kind of starts in the private sector. The government takes over a bit of it. But then he talks about later where the last place where the debt goes is the central bank. It sort of like flows through there. So what I did here is, it's a little awkward, but I wanted to get, and I couldn't download the original data for this, but this is from the Federal Reserve, and it has the state and local debt and the federal debt. That's this, the red and purple line. But then it also has the household debt and the business debt. And then over here we have trillions of dollars. And what I've done here, a little awkwardly, is I overlaid the amount of debt, or the total central bank in black. And kind of what I'm trying to show is like how it flows through, how this private sector debt sort of goes from here, and then it sort of goes to the public sector, and then it kind of ultimately ends up at the central bank. And after the central bank, it's really got nowhere to go. That's where it's going to go to die. And I thought that was a big point that sort of drives the overall long-term debt cycle.
Actually, it's like number 1, though, that black line. It's funny just how small it looks on this scale. It's like you talk about the Fed's balance sheet, $7-8 trillion. It's like, oh, you like squint down there at it. It's like, oh, that's the entire Fed balance sheet
Yeah.
compared to the total debt outstanding. Yeah. So it's almost like you said, this is like where it goes to die. This is like the residual debt that no one wants almost.
Yeah.
And like 2008, I guess you just kind of squinting at this thing. 2020, there's a jump higher in both the central bank and in that federal, state, and local right there. They seem to coincide pretty cleanly. Whereas like you see it jump in 2007, but it's not quite as obvious up in the federal and state and local in the same way.
The other thing, just for context too, the GDP is like, was it like 30? It's like this, like here to here. So like overall, like total debt, just kind of eyeballing it, looks like it's like 200% of GDP if you include the private and the public sector. Food for thought. Stage 3 and 4, I had trouble kind of putting on here. I think that might be more for maybe non-US stuff. Again, a lot of the charts and graphs that you want to look at are like FX and like currency and reserve levels and stuff like that, and defending currencies and all that, and not applicable. But stage 5 I thought was very interesting and very clear. So rates hit 0. Central bank buys bonds to keep rates down and ease credit. Government shortens maturities. And so this is directly from his book. This is what it looks like. Central bank bond holdings as a percent of GDP. That's what this red line is. So we'll see like in 2007, it jumps from like 5% up to like, call it a little north of 15. And here, what he's kind of done throughout the book when describing it is he shows the difference in just broader trends, but he splits it up by kind of floating. With the floating cases, what that's referring to is floating exchange rate cases and then fixed exchange rate cases. Again, doesn't really apply to the US. And then all cases on average. So, we're looking at numbers that are in the ballpark here. The other thing, though, is like, obviously, this is going, central bank bond holdings as a percentage of GDP just blows this chart out of the water when we're in today's. But even if you look at it, the shape of the floating rate cases looks very similar.
Even after the crisis period, it continues increasing. But if you are not the reserve currency, if you're one of those red lines, like you're forced to go back down after that crisis period.
And even like the timelines are somewhat similar. So this is months. So this is like 10 years, right? From 0 to 120 months. That's about 10 years. So here's 2008. And then even like 2018, I got the timelines about right, the shape. You got to squint a little bit. But as far as like projections and overall models goes, that's not bad. That's not bad. The other half of this that they want to talk about is the share of debt maturities maturing in less than a year. Now, this data is a lot harder to get at the granular level, but there are some websites that track this. And I can just say that we're at about this number right now. It's about a third of all the debt is coming due. So it's about 30 trillion. And I think we have 10 trillion coming due in the next year. Putting it in these terms, the way they split up the treasury market, they call them bills, bonds, and notes. And, I don't need to tell you, markets boy, but the bills are the short-term stuff. That's due within the next year. Notes are like what, from 1 to 10 years? And then bonds are like 10 plus. What is it?
I think bonds are just the 30-year, and basically everything that's not. But that's a good question though, because the 20-year, I'm almost certain that it's the 20-year note, not bond. It's just 30 years. The long bond they call it. Everything else is notes. Yeah.
So you can see that the point is that this bill section is 20%. So right there, you've got 20% of the debt coming due because it has to, because it's in a bill. And then you can kind of guess that there's probably like 10% or so coming due amongst all the notes and the bonds and the other stuff. So like, this looks about right. We're at like these numbers in terms of the short.
One sec, I've got Yeah, because bill supply as percentage of outstanding treasury debt is something that people look at quite a bit. We're actually higher as a percentage before 2008, and then it spiked up quite abruptly, and then it went down to very low, like after rates went to zero throughout the 2010s, and then obviously in COVID, it spiked up again over the 20% range, and it came down again because again rates went back to zero, and then starting in I think late 23 throughout 2024, it's actually something that Bessent criticized Janet Yellen quite a bit about. He was saying you're over relying on bills way too much to fund the government. And then lo and behold, he's now the secretary, and he hasn't yet changed that policy.
He's doing the same thing. Yeah. He even mentioned that in that All In episode. He said, I didn't change that policy. And I guess when if you're faced with borrowing at, 3% versus 5% or whatever, it's like, damn. He said like what did he say? 1 basis point's like $1 billion. 1 basis point. The option is saving like $200 billion a year in interest costs. All right. So that's going to be stage 5. The next one, 6A. So the next thing that he says, when rates rise, the central bank is cash flow negative. So rates have risen, to fight inflation. Not going to go over that. And once that happens, the central bank is forced to pay these short-term interest rates at like 4. At some point, it was over 5% for a while. It's since come back down. But then that's how much they pay. But then how much they're actually getting from in interest on the asset side. So this is going to be all the, MBS that they hold and mostly the treasuries is going to be whatever it is, like 3% or something. Now, a bank does not want to operate, if you see a bank who's paying more in interest on the liability side than on the asset side, then that bank is going to die. That is not how banks make money. Central banks, though, they're very special, and they can do these, they can survive a negative cash flow situation, which is what the Federal Reserve has been doing since like mid 2022. It can do that because it's got the backing of the federal government, and it can print its own money. I think probably even more important, it can print its own money. So he Dalio says very clearly that that's probably stage 6A. 6B is much more serious, and that has to do with that's kind of signaling the beginning of the death spiral for the central bank, when it can no longer cover those cash flows except by printing money, which as of yet is not the case.
What needs to happen such that the central bank must print money to cover these ongoing expenses? Like I would argue that mechanically speaking, it's a reduction in demand for the government debt, right? And I think people were kind of eager to say that, or I mean, maybe not eager, but it was something that really hasn't been seen before. And we got a little like glimmer of that during the Liberation Day event. Whenever you saw Treasury sell off at the same time when you were seeing other risk assets sell off, which is, you just don't really see. But to me, and I think that's what kind of motivated that interpretation, is that that's a clear reflection of people are kind of getting a little fed up with, whatever the U.S. is doing. The interest rates are just not high enough to cover the risk.
Yeah.
And so if it if people maintain that point of view, then I think that's like a solid transition into 6B. So it doesn't seem to have happened yet, because that trend over Liberation Day turned around very quickly, and people seem to be pretty complacent again. People seem perfectly happy to continue holding treasuries. We haven't seen a structural shift in the foreign demand, when that's like a really big one. But if we were to see another Liberation Day event, their style event, maybe we see 5 of them in a row over the next couple of years, maybe that's our, could be a transition into that 6B state.
Okay. Yeah, that's interesting. Dalio actually also provides his own kind of future red flags. We've talked about a lot of them to date. The future red flag, though, he says there are 2 of them, 2 big ones. One is if there's another round, and this is to your point, Joe, like if they can't find demand for the U.S. debt, and the federal government is forced to buy it. And there's another round of QE to kind of get interest rates down. That's a big red flag. That's a big future one. So we were looking at this chart. We were talking about like these other steps of QE. I think the next step of QE would be a big red flag per Dalio. The other one he says, and this is a little bit more kind of on the politics side, is if the central bank or if the central government gains control of the central bank. That's not really in the realm of possibility. Well, and that's a big statement.
People are a little nervous about that.
They're a little nervous about that. I sort of poo-pooed it. And Trump walked that back so fast. I think, we know that is like a sacrosanct concept in the world of finance.
So was the previous global trade order, right? Maybe not quite a sacrosanct, but what I'm getting at is, fine, he's not going to fire Powell, but Powell's term is up in like 9 months, I think.
Yeah, and if he puts like Besant in there,
someone who's weird, super beholden to him, then that's a little bit of pseudo control, I would say.
Fair enough. But anyway, those are the big future red flags to look out for, according to Dalio and us. But it's all demand for government debt. I think the other thing he says, like, this is another really important point that Dalio says. He's like, actually, this would be a good transition to what I think the next thing we should talk about, which is, A, when do you think this is going to happen? And then B, what should you do to get ready for it? So the people at Bridgewater, what are they doing? What sort of trades are they locked in on? And I guess you got to look at, when this breaks, and he uses the word inevitable, like it's inevitable, it will happen.
Right.
The currency weakens. So like one thing you could do, again, this is not financial advice. This is just probably kind of how they're going to try to make money on this quote unquote inevitable event. The hard part is figuring out when, right? I think it will happen. You just don't know when. But if you have a view, you can try to monetize it. And one thing that they would expect is the U.S. currency would weaken. So you could short the USD, or you could long foreign currencies, expecting the U.S. dollar to depreciate. You could buy gold, or I think he even mentions like Bitcoin. One of the interesting tables that he looks at has to do with the return on gold versus whatever the currency is that was kind of being devalued.
But yeah, but more so, I would say even like private sector debt as well. I mean, because that's kind of what we saw in 2008.
Short bonds. That was my next one.
So, like some of the biggest names out there, like they shorted the MBS market because they saw that what was going on was unsustainable. It's like, we don't know when, but this doesn't make sense anymore. So I'm going to buy some instrument that is going to basically protect me from things breaking.
Right.
And yeah, it's like the other thing, like the best example, or like one of the most well-known is, the first one that you said, Luke, shorting the dollar, that's what Besant did. He was technically there, but George Soros back in 1991 with the pound, they kind of famously identified one of these events where it was just inevitable. And then they took out a short position in the pound in massive size, not only so that, they would profit from it, but it was so large that it had a material impact on the operations of the UK government itself. And it kind of forced the government into making their trade pay out.
Yeah. That's the power of leverage for you.
Like, I guess the question, and I was thinking about that one. It's about timing, right? When does it become inevitable? And the 1991 case, or, at least in the UK, it was a lot more clear because they didn't have like a fully free floating currency. Well, I guess they didn't have a free floating currency at all. That was like in the prelude to the euro. They were coordinating all of the European currencies to peg to the German currency. And so that was effectively what happened. They realized that the UK economy was doing more poorly than the German economy at the time. The German economy was I think this was just after 1991. So it was shortly after the fall of the Berlin Wall and reunification in Germany. So there was a lot of fiscal stimulus to kind of bring the country back together. And so as a result, they were seeing inflation. So they were raising interest rates. That was strengthening the German currency against everything else. But all of these other countries needed to kind of keep up with that strengthening. But at the same time, the UK economy was faltering quite a bit. So at the time, whenever the Germans were raising rates, that was weakening the sterling. But the UK also needed lower rates instead, which is further downward pressure on the UK, or on the pound at that time. And so the UK central bank had to support the sterling to maintain that peg. So they had to keep spending their reserves down, and they basically saw this is the point of no return. They just don't have enough reserves to keep this going. So we're just going to push them over the line.
Yeah.
So that just really doesn't exist in the U.S. example, because the dollar, still just like stands alone.
Exactly. And I think that's one of probably the problems that Dalio, and certainly I've had when I'm trying to slam sort of his framework onto the U.S., because we don't really have those indicators to look at, the reserve and the exchange rate, because they are the reserve. So like how that's going to impact the analysis is a huge question mark. Mm-hmm. And I think Dalio does this, and he spends a lot of time. It's not a very long book, but he spends a good amount of time and ink detailing how he doesn't say this is going to happen immediately, but we are weakening our financial condition. And more importantly, you cannot look at the big debt cycle outside of the other broad major forces that shape our world. And he spends some time detailing those. He talks about the domestic order, disorder force, and he talks about polarization in the United States. He talks about the second major force, that's the international order and disorder force. And he points to China, Taiwan, Russia, Ukraine, Israel, Iran. He talks about forces of nature. That's sort of the third force. And he talks about forces of nature, climate change, pandemics. And then finally, he talks about number 4, which is technology and human productivity. So that's actually kind of one of the few rare positive potential ones, which but people point to, it's like maybe AI is going to pull us out of this or whatever. We're just going to become so incredibly productive that we can, all the amount of money that's sloshing around, we're going to need more of it.
It's just going to explode.
Exactly. And we need all that money to be in the system. So and then there's no way really to predict like the next COVID. There's no way to predict a meteor strike or some force of nature. It's no great way to predict what's going to happen in China and Taiwan, as we've talked about at length. But that's going to be like the next major, kind of the next major thing, I think. But regardless of all that, so even if you want to say like, look, we don't know, don't worry about it. He's also pointing out that we're just weakening our position, or weaken our financial position to be able to handle one of those big forces hitting. And we shouldn't do it. It's just a matter of time. The next major test, to my point, to kind of do I think, I'm really curious to see what's going to happen when the Social Security thing runs out. That's going to be a huge test. And we're talking like maybe 5, 6, 7 years on that.
Mm-hmm. Yeah, I think I saw a headline just the other day, something like 2034. They're saying they would need to reduce all benefits by 23% at this rate.
Or, maybe we'll just have people work until they're 80. That'll do it.
That hasn't gone over too well in Europe. Past few times, that's
yeah, right. I remember, I think about France, a bunch of farmers dumping poo everywhere. That's sort of my association now with taxes in France.
I think that I forget. So, I think it was Denmark recently raised it to 70 years old is like the official retirement age. That's getting pretty up there. I can't remember, but I think there was something about, though, they had like an adjustment, like a health adjustment.
Yeah. Maybe we can get a carve out for kids that start working in mines at like 5. You can end it at 65. How about that?
Yeah. All the more reason
Why are we always going that way? Yeah. Why don't we start pushing down? But 15-year-olds can work. They want to work.
You see that meme
I
where it
figured
was
it
like,
out. Oh my God.
taking
it.
children
The root of
out
all
of
evil.
the mines.
We gotta. Oh my God. We gotta put kids back to work.
Hey, look, Minecraft. Kids want to be in the mines.
Although, in all honesty, like, you know, it is pretty interesting to see how, I don't want to say desperate, but like my son and daughter, they really want to do things themselves and they really want to help. Just not for very
that's
long.
just
I mean, they
good
get like
parenting.
they get a taste of it and they're like, all right, I'm
Yeah,
doing something
actually.
else. Yeah. And I'm like, no. When you stop wanting to do it, that's when the work starts.
Yeah.
We covered a lot. You know, there's obviously the whole book. All right. Okay. You got me. Okay, Joe. The whole book isn't on that slide. Okay.
To be fair, it's pretty close though.
I would say we sort of did an overview. We did part 1. We did part 2. We did part 3, most of it. We didn't talk about he spends like one chapter on the China debt cycle and the Japanese debt cycle, which are also super interesting, which we didn't talk about. And we talked a little bit about what's looking ahead. He wants to talk about his solution. It's pretty straightforward. 3%, you know, just get the budget deficit to 3% of GDP and then start cutting spending. It's nothing like,
that's right.
That's why I didn't spend a whole lot of time on it, but it's like, okay, do spending cuts, raise taxes, and interest rate cuts. Interest rate cuts are the most important. And then I, you know, basically I talked about what the future looks like to him. So what his indicators show, he sort of, you know, he gives you these huge tables as to like where we stand and stuff. I think I'm probably going to cut this out. But he gives these huge tables. I'll just explain it. I don't know when like we start passing over from like fair use into like copyrighted territory. So, but I'll just say he just gives a lot of tables. So that's his book. So we read it, so you don't have to. Although, you know, it's very interesting. I think we sucked out all the most interesting part and we used it. We used it for our own content. I don't know. Well, good talking to you. Thanks everyone for tuning in. This has been another episode of the Root of All Evil podcast. I think we're going to try to move away from debt stuff. Honestly, it's not very popular. People don't want to talk about it. I think it's super important. I think it's interesting.
Yeah.
We're going to try to do something. I'm definitely not going to cover debt next week for my episode in 2 weeks.
We've seen a bit of a dip in view count here.
Yeah. But thanks for tuning in and see you next time. I'm Luke.
I'm Joe. See you then.
Take care.
Bye.
Bye.